Bill, while the interest rate cut is a big deal for mortgages, it's also a big deal for other things like your credit cards and your car loans. How this rate cut could impact you. Next. Welcome back. It is 3:12 on your Thursday afternoon. Well, big news if you're looking to borrow money for a house, a car, or something else. The Federal Reserve just announced that interest rates have been lowered for the first time in nearly a year. This also impacts your bank accounts, investments. So to help break it all down for us, we have financial strategist Bill Dendy with us today. So, Bill, the Fed's cut interest rates by 0.25%. It doesn't seem like a lot, but what can it do?
Well, it's not a lot. It's a beginning. But it sure is welcome because it's been 9 months since our last cut. And the Fed at that time said they wanted to lower rates, but then they have not done so because they're afraid inflation was not yet under control. This cut is a sign that, and they actually said that they plan to do some more cuts going forward. So 0.25 point, that helps. We're going to see it in certain areas, but it's not that much yet. But what's really important is it's kind of like we loosened up this log jam and we're going to start seeing these rates come on down, probably a couple more cuts this year, another cut next year. We might lose a whole percentage point before the whole thing is over. And 1 percentage point, that does make a difference.
So I was going to ask, Bill, should we go ahead and refinance our home? But as you were talking about more cuts possible, maybe we should wait to refinance?
I think we should probably wait for the refinancing, but for some people, this little cut's all they needed to go ahead and get a little more house for the money, and that's positive for the home loan industry. But for those who have HELOC loans outstanding that are tied to prime, they're going to see that 0.25 point reflected probably in the next couple statements. So they're already going to see their cost of that loan going down. For those who have variable interest rate credit cards, the credit card rates will probably come down. But 0.25 point doesn't really hit you that hard when you're paying 20% interest. So we might not see it, but it's a positive sign that things are going in the right direction. And we're going to start seeing it in various areas, but it may be too early to refinance. But the housing market is excited to see that rates are coming down. And while the home mortgage rates are tied to more like the 10-year notes and longer term projections of the economy, lower interest rates are usually a good sign for the economy because it keeps people working, it keeps companies borrowing money. It's going to probably be well received by the stock market. It was kind of already built in, but we're seeing some of the happiness in the markets last couple of days.
Well, we like happiness in the markets, and my next question was going to be about our investments. So how does this impact our investments?
Well, for those who have equities, we're going to see a little help. Companies borrowing money, they're able to refinance at a lower rate, and that's going to be positive for corporations. Those who are carrying a lot of debt, that's a very positive thing to have interest rates lower. As you know, the White House has been asking for the Fed to lower the rates rather aggressively for this whole 9-month period. So we're seeing that lower rates good for equities, good for common stocks, good for corporations. Not so good for mom and pop who are living off their fixed income, who are getting used to CDs that were paying 5% again. That may be gone now. We might be seeing the 3 to 4% on the fixed income for high investment grade. So for some people, it's going to be a big positive. For others, it's a little bit of a negative as these interest rates have come down already and they're liable to keep on coming down.
What money moves are you recommending for your clients right now?
Most of the moves had to be done a little early. This is a sign the Fed doesn't lie. They tell us what they're going to do. And we've had some dissent within the Fed, but they're going to continue to lower rates down, which means it's a great time if you got a little bit too aggressive in the market to maybe get that fixed income and get the 4 and 5% on the more stable fixed income investments, while we can still get in 4 and 5%, because 2 or 3 years from now, those may not be possible. In addition, for those who've had equity exposure, we've seen the market move up. Stock market is near all-time highs. That's a good time to re-examine, just in case we start slowing things down again. And keep in mind, the Fed uses interest rates to cause it action in the economy or not. The reason the Fed was slow to lower interest rates is because it usually is like pouring lighter fluid on the fire of the economy. That's positive. That should be positive for those who are unemployed. Seeing more activity makes the job markets more robust as well.
Bill Dendy, thank you so much. Where are you real quick?
Right now, I'm at Papa Brothers Steakhouse getting a steak dinner in Dallas, Texas.
We love that. Enjoy your dinner. Thank you, Bill.
Good morning.